Indakshi, you start, please.
This is
Very good.
3.59. Okay, okay, just okay. Please.
So shall I start now?
Yes, start, please.
A very good afternoon to everyone. I'm Indrakshi Bhattacharya from the BFSI board. Welcome you all to the webinar on the topic Understanding the Basics of Commodity Market and Energy Price Risk Management. And this is organized by the Banking, Financial Services and Insurance Board of the Institute of Cost Accountants of India. And we have with us as eminent speaker today, Sri Ashish Bhaktani sir. He is the Assistant Vice President, PMT Energy, Multi-Commodity Exchange of India Limited. We welcome you, sir. From the institute, we have with us our chairman, sir, CMA Chitranjan Chattopadhyay, sir. He is the chairman, BFSI board, ICMAI. We welcome you, sir. We have with us our HOD, sir, CMA Dibyendu Roy, sir. He is the additional director and HOD of our BFSI board. We welcome you, sir. And we also have with us our BFSI officials also. So just before we start, we are playing the institute anthem, and then we will continue with the program.
সিস্টেম থেকে বাজে নিতে পারবে।
I think we should continue.
Yes, yes.
চলো চলো So now I would request our chairman, sir, CMA Chitranjan Chattopadhyay, sir, to give his address. Sir, please.
Very good afternoon to you, to all the attendees. Wish you a good day. Today we have already announced that one of the in the Diwali days, Diwali days we are very much passionate to present before our speakers, before our attendees, one special Diwali special webinar. So we consider this as a privilege for us to present before you a special webinar on understanding the basics of commodity market and energy prices management. And it will be dealt by a very competent personality on this particular, commodity market. Mr. Ashish Bhattani is the Associate Vice President of PMT Energy Multi-Commodity Exchange of India Limited. And today this session would be very much memorable, I can assure you, because BFSI board has always had the endeavor to bring some sort of, capacity building. They want to create capacity building amongst the CMA members. And of course, our students also, many of the students have also joined this program. I welcome you all. Let me tell you one thing, that this commodity, when we are talking about this basics of commodity market and commodity market and energy prices management, this learned speaker will be definitely discussing the fundamentals of commodity markets and energy price risk management. The commodity markets play a vital role in our economy, and understanding this market is crucial for business and investors. And if you talk about the basics of commodity market, a commodity market is a platform where physical commodities like crude oil, natural gas, gold, and agricultural products are bought and sold. And key characteristics of this commodity market includes price volatility, global demand and supply, market speculations, futures contracts. So this particular session will be very interesting for you. And as you all know, commodity markets are categorized into, soft commodities, that is agricultural products, hard commodities like metals, energy, and energy commodities, crude oil, natural gas. So it has got a tremendous linkage with the energy price risk management. So if you want to talk about commodity prices on that, when you are talking about, we have to also understand how the energy price risk management matters. The energy price risk management involves mitigating potential losses due to price fluctuations. And many of the strategies, as we know, hedging, this hedging is, locking in prices using futures or option contracts. Then diversification, as we know, these are also included in our investment management and investments options, spreading investments across various energy sources, price ceilings and floors, risk management tools like swaps, options, and futures. And obviously, you'll be listening from our esteemed speaker that energy prices management is crucial for energy producers, consumers, traders, and investors. So as a CMA, we have got a huge role to play. And if you talk about the energy prices, the price volatility risk, basis risk, which is in fact a difference between local and global prices, then liquidity risk, regulatory risks comes into the picture. And if you understand how to manage energy price risks, who will be the better person than our Ashish ji, who will be delving on monitoring marketing trends, develop risk management strategies, diversify energy sources, and continuously reviewing and adjusting the hedging positions. So all this in this 2 hours webinars, you will be listening. I'll be requesting all of you to please put your questions here in the chat box and get yourself clarified from our very esteemed speaker. It is very difficult to get the speakers like him when we'll be talking about this sort of, very special type of, this sort of topics. The people are also very special, who are having the, USP on this whole matter, who are having the skill in this matters. So Ashish will be delving on this. Friends, in conclusion, understanding commodity markets and energy prices management is essential for navigating today's complex energy landscape. By recognizing this market dynamics and implementing effective risk management strategies, business and investors can minimize potential losses and maximize opportunities. So in these Diwali days, forthcoming Diwali days, you wish you have a very good, potential profits, and as also minimization of the losses, and you will be definitely with the these festive days, we are sure that you will be maximizing your opportunities. I thank you all for being with us, and we'll be looking for your further participation in near future when we'll be bringing more such important topics, and we'll be definitely also assuring you value oriented and add-on value webinars for your benefits, and you can really feel yourself proud to be a CMA through these sort of programs. Thank you.
Thank you so much, sir. So now I would have the privilege of introducing our speaker, Mr. Ashish Bhaktani, sir.
Mr. Ashish Bhaktani, sir, he is associated with Multi Commodity Exchange of India Limited, MCX, since 2007, and is currently Assistant Vice President in the Energy Division. He has over 20 years of experience. He manages relationships with large members and broking houses, pan India basis, and corporates in the financial sector. He is responsible for promotion of energy contracts, meeting corporates for risk management, contract designing and promotion, launching of new commodities, seminars for promoting energy contracts, and interaction with the regulators, and many more. So we welcome you, sir. It's really an honor for us to have you with us today. So now requesting Ashish Bhaktani, sir, for his presentation. Sir.
Thank you so much, Indrakshi. Thank you at the outset. Good evening, all the participants and attendees for the webinar. And at the outset, I'd like to thank Chittaranjan Chattopadhyay, Chairman ICMI, and Dibyendu Roy for giving us this opportunity to speak at this webinar. Now, as Mr. Chattopadhyay said, that commodity market has seen its inceptions way beyond this century, and it goes back way back to the 18th century when we had in the US market and the global market, we had spot markets trading right from in the cotton sector, cotton commodity, for the matter grains and oil seeds, and of course oil and natural gas products. We also saw the inception of international exchanges in that decade, in that century, when we had the Chicago Board of Trade coming through. Then we also had the New York Mercantile Exchange, the CME Group, which is now called under that umbrella. And we also had, on the domestic front, we had various associations who came into form, various spot markets, the mandis, which were especially for the grains, rice, and oilseeds, and of course for the for the oil and gas market as well. So not to forget the cotton market, which had its inceptions quite a long time back, and that's how the history and background of commodity market has been. Now, over the period, what happened was, as there was a need felt for risk management and commodity trading in India, under the aegis of FMC in 2003, commodity market had its inception in the form of futures derivative exchanges, and in November 2003, in the birth of MCX took place. And since then, exchanges have come up on the agri front and the base metal and energy sector, which prime focus was on bullion, that is the gold and silver market, energy markets, and of course the base metal markets, and also the agriculture sector. Now, without taking much of your time, let me just get into the presentation part. So today we are going to talk about commodity market ecosystem. and energy price risk management through the derivatives tool or the options, futures and options available to the commodity participants across the exchanges. So starting out, there will be a brief disclaimer here that this does not constitute any professional advice or any kind of trading or investment strategy. This is purely an awareness seminar or webinar on commodity market ecosystem and of course how we can do risk management, especially in the energy sector. Now, my presentation is spanning out in four main areas, which is commodity market ecosystem, exchange mechanism, energy markets and risk management, and the derivative contracts in the energy segment. Now, to start out with, what happened was in 2013, we had this transition from the Forward Market Commission to SEBI, which is Securities Exchange Board of India, which became the regulator on of the commodity exchanges and also the for MCX and other exchanges in the year 2015. And basis the SCRA and SEC regulations, stock and commodity derivatives segment came under the stock exchanges business rules and guidelines. Along with that, what happened was the we had futures which were launched in 2003, and subsequently the energy contracts came in 2005. But over the period with the regulations in place for options, the options trading in gold, silver, crude oil, and copper, zinc also commenced in October 2017, especially starting out with gold and silver. Now, under the stock exchanges, there are members who form the core or the crux of as a stockbroker or a member of the exchange, and it runs around nationalized brokers to other members and as bank subsidiary brokers who form a part of the member as with authorized persons under them. And finally, we have the clients who trade through these members and brokers. Now, what happened was in once the formation of exchanges took place, there was an integration of equity and commodity derivatives segment, and single exchange operating was formed under the stock exchanges nomenclature. Now, predominantly, as I mentioned to you, that we have the physical markets. We had the physical markets dating back to the 18th century in the international market and also in the domestic market, where you had the spot market, or if you like, the mandis or the trading zones, areas, the trading hubs, which were available for trading in various commodities. And it was known as a spot market for immediate delivery. Then we had some contracts which came in, which were not standardized but customized contracts in the form of forwards, which were customized to suit the requirement of both the buyer and seller, and basis which they came into existence as forwards. But then what happened was, since there was no guarantee of these contracts, the standardized need for the hour was for formation of standardized contracts and having a guarantor in place who would settle these contracts and also guarantee the contracts for final settlement, wherein the commodity exchanges came into picture and the derivatives segment was formed in the commodity markets, under which we presently have the futures and the options tools available as a derivatives, for these markets to trade in. Now, commodity markets has predominantly been for a trading perspective as well as for a hedging perspective. For trading perspective, I'll get into initially, but later on I'll get into the risk management part, the hedging part. So there one can trade into commodity futures and options Under MCX, we have the various segments like bullion, base metal, energy, and agriculture sector. Now we'll dwell into that more in detail. Now, before I get into the commodity market part, let me just quickly run through just touch upon what are derivatives, and basically they are an instrument which derives a value through an underlying asset or group of assets, and it acts as a price insurance in a volatile market. Now we know that there is stock markets, the currency markets are on, interest rates there. We also have the commodity market in indices, which are also forming part of the commodity market apart from the main four segments. Now under that futures and options segments, we have what are known as major contracts as well as mini contracts. Major contracts are the bigger contracts for traders to trade who have a bigger contract size to trade. And for the retail participants, we have the smaller contracts who can trade in both the futures and options as well. Now, objective of commodity markets was primarily to form basically the risk management objective, the feature, along with the price discovery, having liquidity running through the contracts, and of course integration for spot and derivatives market with a trade guarantee and transactional efficiency to go by, where the investors can take an informed decisions and trade carefully in the market. So based on these six parameters, you're able to six objectives. The commodity derivatives market on M6 facilitates these main objectives, and basis which one is able to trade and also hedge in the commodity market. Now, apart from the main segments which I talked about, the main sectors which I talked about, there is also something which is known as physical trading, which was basically trading from the perspective of hedging. Again, if a corporate has particular raw material to procure or has some particular finished product to sell, then you can use it. You use the derivatives to hedge against price fluctuations. If somebody wants to trade in the commodity market, that they too can do it without physical settlement, because because the energy contracts are cash settled contracts. Then you have something which is transfer of risk, which we will see ahead, wherein one side you have the trading community, the trading participants, and one side you have the hedgers who have the risk, carry the risk, and how they transfer the risk to the trading community that we will see ahead. Now, a futures price basically is derived from the spot price plus cost of carry, which includes the interest cost and the storage cost for storing the commodities in the warehouse or in the vaults in the godown. So that's how the futures price is derived. Now, here we have various derivative market participants who take advantage or take benefit from the market in terms of arbitrators, hedgers, and speculators. So arbitrators are one who utilize any imperfections in the markets to make profit. So that could be a inter-exchange arbitrage, there could be an inter-commodity arbitrage. So, or they could look at even from trading from the speculative perspective, from trading in a commodity with a view in the market, or they can use it from the hedging perspective. Now, as I mentioned to you that there is a transfer of risk which takes place in the entire ecosystem. Is basically one side you have the financial investors, you have the arbitrators, and you have the institutional participants like mutual funds who assume the risk of the hedgers, the corporates, the farmers, producers, and consumers, and the merchandisers who carry this risk in the market, risk exposure, and that risk exposure is transferred to the investors who assume the risk because they have a particular view in the market, and basis that they're able to trade in the market and provide the much required liquidity in these contracts for the hedgers to hedge and transfer the risk of volatile prices. Now, on one side, stock exchanges have the various participants like farmers, corporates, the importers, exporters, traders, and of course associations and government regulator who forms the regulations for these commodity stock exchanges. On the other hand, there is also a clearing corporation which takes place of the entire delivery mechanism right from trading, from clearing to settlement. So there could be a trader, there could be a farmer. What happens that at the time of delivery, they deposit the goods into the warehouse or the vault, and they go undergo a quality checking and a testing basis with a warehouse receipt, and a quality certificate is given to the uh, seller who deposits his goods in the warehouse or the vault. And under that, we have what is known as the clearing corporation, which has a system which is known as Commerce, which does the entire under which the members register their goods and provide for delivery on the exchange platform. So on one side, you have the trading platform, which provides these participants to hedge on these products. And the other side is a clearing corporation, which is also part of the stock exchanges. And they do the uh, clearing and settlement aspect of these contracts for these participants who hedge or trade in these commodities. Now, as I mentioned, we have the four key segments: bullion, energy, agri, metals, wherein these are the commodities which are traded on commodity markets. And in precious metals, we have on MCX, we have gold, gold mini, silver, gold guinea, petrol, crude oil, natural gas, copper, aluminum, lead, nickel, zinc, brass. And here we have cotton and mentha oil on MCX. Now, moving on to the exchange mechanism, what is very important to note is that the main function of a stock exchange or commodity in the commodity segment is basically it provides for price discovery. When there are multiple buyers and sellers trading in the commodity market, they bid and ask, provide the bid and ask into the system, basis which the top buyers and sellers, top buyer and seller will who match that get the traders, the matching is done, basis which a price is discovered for that particular trade, and that's how the efficiency of the market comes in. The other function is price risk management and of course facilitating physical trade, because here there is also the system of uh, providing for delivery on the exchange platform for all the base metal, bullion and agri products. We have these are all delivered products. So you are able to provide for provide for delivery and also take delivery from the exchange platform. The other aspect is that because of the the entire ecosystem being in place and the value chain participants involved in the commodity market, there's also good smooth credit flow which takes place from the buyer and seller side, and that is also a main function of the commodity derivatives market. And of course, the asset class, because of this of the commodity markets like the gold, silver, and commodities like gold and silver are provided from an investment perspective. They also provide as an asset class for trading in the market and also for investment purpose and also for hedging purpose. Now, these contracts on the exchanges are standardized. So here you have a buyer and seller, and these are non-negotiable contracts which are publicly available in the system, and these are online. These are online markets which provide for liquidity, high liquid contracts in the stock exchanges in the commodity segment. Now, on the operational aspects, one important point here is that if somebody has to trade in the contract, there is a exchange provides for a leverage to the participants to trade, but for that one has to provide an initial margin into the system before basically trading in the commodity market, and that is where that is set based on the different positions that he carries into the system for trading, and that decides the initial margin based on the average volatility for the underlying commodity concerned over specified period of time. So for various contracts, there are various initial margins set by the regulator, which becomes applicable for the commodities for trading, which we will see going ahead. Now here another aspect is that based on the amount of exposure which you need to take into the market into the commodity, there will be an additional exposure margin which is taken, which is known as a span margin, which is basically to cover the volatility which is prevailing in the commodity. And of course, based on the position you have taken in the market on a daily basis, there is a mark to market margin which is done, which covers the difference between the cost of contract and its closing price on the day of the contract is purchased. Post that, M2M covers the daily differences in closing prices. Now, apart from the initial margins which I mentioned and also the exposure and the mark to market, there is also something which is known as the extreme loss margin. That is basically to cover the VAR-based margin. It's a VAR-based margin, so cover the extreme scenarios which can occur into the market. And then you have additional special margins which are levied into the system when there is excess volatility, like the recent conflict between Iran and Israel, which is going on. That time we had seen a lot of changes in the margin requirements for the energy contracts. Sometime back we had the ongoing Russia-Ukraine war that also created a lot of ruffles in the market and had called for higher margins to be placed. Then concentration margin is basically based on member level concentration, so that the there is no excess contracts which are taken into account by any of the member. So that's why the concentration margins is levied. Then you have something known as delivery and tender period margin. So the tender period margin is, for example, if the expiry of a contract is on 31st of or 30th of a month, 5 days before the the contract, the buyer and seller have to provide margin. Buyer has to provide a margin of basis his intention which he has given for delivery. So that is one aspect, and delivery margin is post closure of the contract. That is where the delivery margin comes into picture. Then you have the devolvement margins and the short option margin. Apart from that, other risk mitigation measures that are taken into the commodity system are real-time measures. So if there is a exposure which has a margin utilization which has taken place, or M2M loss monitoring alerts which has taken place, there the alerts are sent out to the client or the member level, which sets as 60%, 75% and 90%. Apart from that, there is also daily price limit. So based on the closing price, previous day's closing price, there will be a daily price limit which will be set. And there are collaterals which are accepted into the system from not only from the bank guarantee also, but from the FD side, and non-cash collateral from GSEC and warehouse receipts are taken, and eligible securities as well. So these are the host of risk management measures which MCX employs for safeguarding the participants into the system. Now, before we get into the risk management part, I would like to highlight that in the commodity market as a whole, as Sir was saying before, the peculiarity of this market is that it is a global market, and it is affected by global demand and supply, economic conditions prevailing globally across the world. That is, then you have the interest rate factors, then you have the weather conditions, inventory levels, rig counts. These are the host of factors, so key factors which predominantly decide or determine the price of a commodity, whether it is for energy products or for bullion or for base metal or agri commodities. Now, moving into the energy markets and risk management, particularly, as I mentioned, in the host of factors, there are particular factors which are responsible for affecting the price of oil and gas in the global market. And some of them to highlight here are the weather variability, alternative fuel, natural inventory data, the rig counts, the industrial and residential demand, global economic growth, industrial growth, inflation, and that is interest rates. And of course, we have the geopolitical events, which I mentioned about the Russia-Ukraine war and the conflict between Iran and Israel, just to highlight. And the trade policies, the recent trade policies between China and US are to have come into limelight because of the tariff and the barriers which they are placing. That is also affecting the prices of various commodities. And here also it affects the trading in the oil and gas markets. So these are the host of factors, especially OPEC, which is the producing exporting countries association in the Middle East. And they have key announcements to make in a year, which decide the quota for these member countries. And they make the changes and affects the prices of oil market especially. So these are the host of factors which affect the oil and gas market, especially uh, in the whether it is for trading in oil markets globally or also for the domestic prices, because the domestic prices are also linked to the international prices, because what we are uh, major importers of crude oil and natural gas. So that also impacts the companies domestically based on the international price movements. Now, here are just some key factors wherein OPEC announcements, when they come into picture, how they create prices to fall or rise in the market. Then inventory data. Then we also have economic data which comes through from China, which impacts the oil markets. Then any military clashes which took place between in the Middle East, that is also affecting the prices, that also affects prices. And of course, tensions in the Red Sea, which wherein there was problem in the transportation of ships from a particular area which is in the Red Sea, that also caused prices to rise. And of course, any revisions from OPEC also have an impact, as I mentioned earlier, on the prices of crude oil. Same is the case with natural gas. Here one key factor to note is that apart from the demand and supply, global demand and supply, and inventory and rig count, the weather plays a very important role in global markets, not only in the Europe but also in the US, which has an impact on the natural gas prices and affects the uh, you know margins and bottom lines of the companies, because they use it as their fuel feedstock in the form of LNG. So that is also a key factor to note down, that natural gas prices are also affected by the uh, weather conditions and other economic and demand supply conditions prevailing worldwide. Now, why I highlighted these factors was to just show you how that has an impact on the numbers. So here you can see average daily volatility in crude oil ranges between 1.5 to nearly 3, has ranged between 1.5 to nearly 3%. And for natural gas, you can see it ranged from 3%, 3.4% to 5%. And that is a cause of concern for the corporates who have used oil derivatives in the form of oil products, byproducts of crude oil, and also natural gas in the form of fuel feedstock. Now, as you can see that the annualized volatility for the oil and gas markets has ranged quite high. But for the currency market, which we do hedge, the corporates do hedge, that is quite low compared to what oil and gas markets annualized volatility is low. So the cause of concern is that we are hedging the currency or the forex risk, but the energy price risk or the commodity price risk goes unhedged, and that causes a major impact on the bottom lines of the companies and thereby affecting their margins and profitability. So this is a very key important role to key important point to note down that we need to, wherever we are at the corporate level or at a member level, that this is a need of the hour for the corporates to hedge in the commodity market. Now, just one description is given here that today we are standing at this time, but we don't know where the price of commodity will go, whether it will go down or whether it will go up. So today it can be in our favor, the next day or the next month it can be unfavorable to us. So it's very important for us to hedge in the commodity market and commodity prices so that we can do a commodity hedging not only in bullion, base metal, agri, but also in energy contracts. Now, just to touch upon a little bit of the theoretical aspect, very important aspect to note down here is that we need to have a hedge model in place or hedging, process in place for any corporate to note to have in their hedge policy. So one key important aspect is to understand the risk appetite, and risk appetite is to know how much risk exposure one can take on their balance sheet and how much they cannot. Second aspect is the exposure identification of the risk exposure in terms of which commodity, and then the quantum and the quantity, that is, which one has to hedge in the market, and of course get into hedging transaction, and then at the same time get into a governance of the risk management practice, and also get into assessment of the hedging transaction undertaken, so that if there is any rectification required, that can be done during the contract or the hedging period, so that it can be taken care of and the operating model becomes successful. Now, SEBI from their side have also taken initiatives, as we are aware that in any of the balance sheets we have what are known as LODR requirements, that is distinct obligations and disclosure requirements. So here the companies have to provide in their balance sheet annual reports, that is the risk exposure which they are carrying into commodity market, whether it is the domestic front or the international market, they're doing hedging in the OTC or the commodity exchange. What is the quantum in terms of quantity, and also the price or the turnover in terms of how much value wise they are exposed to in these commodities. So this is a very key aspect which is taken into account by SEBI. Even RBI has given a high risk category to commodity price risk, with 4th rank given to the commodity price risk in the entire Indian financial system out of the 32 risks identified. Now, just to highlight just 2 sectors I've given here. One is airlines and one is fertilizer companies. These are the big companies which are using the crude oil in terms of aviation turbine fuel or the jet fuel, if you like. And the second, the fertilizer sector uses a lot of natural gas. Now you can see on the left side, this column shows how much is the consumption in rupees per crore for 3 companies without naming them. And with a risk exposure analyzed volatility of 40%, that translates to nearly 4,000 crores of risk exposure, which the airline companies takes into India. And that is very important to note down, that much of risk is being carried forward by these companies compared to the forex risk, which is mitigated and for which hedge policy is in place. But for commodity there is a very vital need for commodity risk management to be undertaken by the corporates. Same is the case with fertilizer companies. Here you see nearly 8,000 crores plus exposure consumption is there for company one, out of which again a 40% natural gas volatility works out to 3,300 crores risk exposure. So that is the amount of quantum of risk that these companies are facing, and they need to hedge in the markets. Now, again, just to highlight, which I mentioned earlier, that on a risk management policy need to be in place for these corporates. And for that, you need to have these main factors or main things covered, right? From commodity prices exposure to quantity and volume and value. And of course, hedge instruments need to be identified along with the risk management organization structure for the people who would be involved in the hedging model. And of course, guidelines for reporting and review and control very necessary after having undertaken a hedging transaction. And of course, list of approved bankers and brokers who are on the exchange for providing this hedging transaction. Now here is a key slide which talks about various industries which are exposed to different byproducts of crude oil, right from furnace oil, diesel, naphtha, ATF, light diesel oil, LSHS, benzene, and so on and so forth. So these are a host of companies, right from glass, textile, steel, forging, refiners, petrochemical companies. You have the iron and steel, the various ceramic companies, and of course chemical manufacturers who are exposed to these uh, byproducts of crude volatility. And for that, if because of the correlation being high with crude oil, one can hedge on the crude oil product available on the exchange platform and thereby mitigate their price risk exposure. Because of the correlation with crude oil, they can do a hedging on the crude oil product available on the exchange. Now, this is just to cite one example of how basic example of how one can hedge in the market. So assuming today the manufacturing company's monthly usage is 10 lakh MMBTU, which is a unit of natural gas, basis which they are seeing that their budgeted cost is 20 crores. So on 1st June, if the price of in the spot market is 200 rupees per crore, I'm sorry, 200 rupees per MMBTU, and the futures price is ruling at 202 rupees per MMBTU. So the company has an requirement coming up in the month of July. So what it will do, it is lock in the price of natural gas in on 1st June at the futures price of 2 rupees 202 per MMBTU. Now what happens is that by the time 30th June comes, the prices have moved up to 207 rupees per MMBTU. But simultaneously, even the futures market has risen in line with the spot market. So what happens is that at the time of taking delivery from the spot market on 30th June, the company will square up the entire lot of natural gas which it had purchased on 1st June. And ultimately, as you can see, there is a difference of 6 rupees over here between the futures price and a 7 rupees gap when the company picked up the natural gas on 30th June. So what will happen in the futures market savings will offset the price rise escalation in the spot market. So that's how the net position will work out to 10 lakhs for the corporate. Similar, another situation can take place is when the reversal can happen. If the prices of natural gas were to turn negative, in the sense go down, then what would happen is that when the company would go to purchase in the spot market, it would have got at a lower price, which will offset the futures loss which it made in the commodity exchange. So net in net, what happens is that through hedging, one can actually fix the input cost or the feedstock cost so that one can actually mitigate or hedge their prices. Now, derivatives contracts on MCAs are listed ahead, which are basically crude oil 100-barrel contract, a 10-barrel contract for the mini contract, 1250 MMBTU for the major contract, to 250 MMBTU for the mini contract. Now, all the four contracts are cash settled contracts, so there is no delivery in these contracts. And of course, you have a few options also available on these four contracts, which is oil major and mini contracts, natural gas major and mini contracts. Now, here I have highlighted the contract specification for you. Here, it is the 100-barrel, which I mentioned about the lot size available for crude oil major, mini 110 barrels. Quotation is rupees per barrel, and tick size is rupees 1. So the price will move in the interval of 1 rupee. And of course, as I mentioned to you, that initial margin is 10% for this for both these contracts, and based on the volatility prevailing at the time of in that commodity, it would be an additional span margin which may be applied, whichever is higher prevailing at that point of time. Same is the case with natural gas. Here again, the quotation is in rupees per MMBTU. Tick size is 10 paisa, and again the margin here also is 10 or span, whichever is higher. Now these are the options contract. Options are on futures. So again, the major one is 100 barrel and the mini one is 10 barrel. Quotation is in rupees per barrel. We have strikes available for you. 51 call side, 51 put side. Interval is 50 rupees. And tick size is again 10 paisa and 5 paisa for major and mini respectively. Key aspect over here is that these contracts devolve into the futures contract. So if the expiry of a particular futures contract is on 20th of a particular month, then 2 days prior to the expiry of the futures contract, the options contract will expire on 18th and get devolved into the futures contract. Here again, we have the natural gas options contract, which is basically major and mini contracts as well again, and they too devolve into the natural gas futures contract 2 days prior to the expiry of the futures contract. Now, a key point to highlight over here is that the prices on the exchange platform are linked to the international prices. So whatever we see on the television in terms of crude oil prices, there is a crude oil contract in terms of under the CME group, which is the New York Mercantile Exchange, which is known as the WTI crude oil, which has again a very strong correlation. The MCX crude contracts have a very strong correlation with the NYMEX WTI of 98%. And also another crude which is known as the Brent crude oil, which is the UK-based crude, which also has a very strong correlation with the crude oil NYMEX and ICE Brent. So what I want to highlight over here is that whatever prices are being moved or are being, whether they're rising or falling in the market, that it's a direct linkage or direct mirror image of that on the MCX prices, exchange prices, and that you can actually hedge on by taking a position in the exchange contract, in the exchange crude oil contract, and thereby you need not do any forex exchange hedging because these prices are all in rupees per barrel. So the forex risk gets factored into these prices because these are converted prices from dollar to rupees, and the unit is the same. Same is the case with natural gas here too. These prices are also highly linked to the US Henry Hub, that is US natural gas prices, and that also has a very high correlation of 99% with the international price. Now, talking about the volume on the exchange and the turnover, you can see that futures are quite active, and also the options has picked up quite well. And here you can see that in current year, the crude oil contract has options contract has jumped quite a bit. And also the natural gas futures on the right side, you can see is having a healthy correlation, a healthy open interest, as well as a good turnover, and also in not only in the futures but also in the options, which are denoted by the red bar, and the futures are with the blue bar. So that's on how the basically your options and futures turnover is being has been there in the last 3 years, 3 financial years. Now coming on to the other contracts, we have the bullion contract, which is the gold and silver contract. So the basis for this center is gold Ahmedabad, and we have a gold regular, gold mini, which is 1 kg contract. Lot size for the mini contract is 100 gram. For the gold guinea, which is a small 8 gram contract, and gold petal, which is a 1 gram contract. For the silver, there is a 30 kg regular contract, silver mini 5 kg, and you have the silver micro, which is 1 kg. So these are the major futures contracts which are available for crude oil. I'm sorry, for gold and silver. Then we have the options on futures on gold 1 kg, and gold mini, that is 100 gram, and silver 30 kg and 5 kg silver mini. So that is how the bullion contracts has panned out. For the base metal contracts, we have aluminum mini, copper, zinc mini, nickel, lead mini, and we also have the steel rebar. So you can see the lot size for that is 5 metric ton. The mini one is 1 metric tons across the board, major and mini. And these have various delivery centers from Raipur, Thane, Chennai to Raipur again. And these quotations are in rupees per kg for the base metal contracts, and for steel rebar it is in metric ton, 1 metric ton. So that is how the bullion energy base metal contracts are listed on the exchange platform. Now, if one has to trade in the crude oil contract, these are the main transaction cost or the fees which are applied. You can see on if I'm buying a 1 lot contract of 100 barrels of crude oil at 4,200 per barrel, so it works out to 4,20,000 contract. This is 4,200 into the lot size, which is 100 barrels. So it works out to 4,20,000 contract. Now on that, if I have to apply a transaction value, it works out to 2.1, which is per lakh, that is being determined by the exchange. Then we have a brokerage charges, then we have GST, we have stamp duty on that, we have commodity transaction tax, and a regulatory fee applied. Now, if one has to commence trading on the exchange platform, there is a, whether it is for trading perspective, hedging, or investment perspective, one has to choose a member broker, fill up the KYC at the broker level, provide for the initial margin, and of course mark to margin has to be provided as well. You need to know the rules and guidelines for the exchanges, and of course select the commodity and read the do's and don'ts. So very important to know these aspects right from margin, taxation, and stamp duty, so that one is aware before trading into the commodity market that one needs to be aware about these aspects, the KYCs, and also the brokerage and transaction charges. So that is very important for the participants to know. Just give me a moment. So Moving ahead, very important to know the do's and don'ts of trading on MCX, and the do's and don'ts of on very important, so that we need to trade on a standardized contract and on a commodity exchange platform, and not to uh, go in for any assurances by anybody for saying for assured having returns, assured returns. Trade on a normal trade on a commodity exchange and also with a registered member of the exchange. Very important to note. As I mentioned, that you need to very safeguard your investments and also trade in recognized commodity exchanges, and you need to have trade in through in a very transparent manner, and also keep available for the fair trading. And also there is a risk dispute mechanism in place for the online dispute resolution mechanism, which is provided by SEBI. And under this website, smart ODR, smart online dispute resolution, one can do any kind of we can register their complaint and have the through that smart ODR portal. Now this is the process which I'll not dwell into now, but this is a process for online dispute resolution. Now here we have SEBI has also started their investor website, which is investor SEBI government.gov. That's the website which they have started for the investors specifically. And then we have the Sarthi app, which is available on the Apple and Google Play Store. So that's available. You can also look at this and get the wealth of knowledge, and of course, various educational videos and resources will be available on that particular app. So this video is also there. So the video and of course you have a lot of information available over there. Now these are the various investor service center or MCX across India, which are available to the investors if they have any queries or grievances, or if they have any requirements to understand more in depth of the commodity market. They can go to these centers across the country. So with this, I would like to conclude my presentation, and I would hand it over to Devendu Roy for further, for any particular deliberations which we want to do on this. Thank you. Yeah, Indrakshi.
Yeah, thank you, sir. Thank you for such a vivid presentation. So, sir, we have a few questions from the participants. The first question is from B. Kumar. Sir, what is reverse hedging in the oil and gas markets in the international trading?
What is, sorry, you said what is leverage trading?
What is reverse hedging?
Reverse hedging. Okay. So basically, in terms of if one has to look at in the commodity market, if one is having raw material to procure and also has feedstock to garner, then one can look at basically locking in their position by taking a contract in the futures and options. But if somebody is having a finished product available in the market, which they want to look at hedging, so in terms of they can do that as well, because if they have, for example, if a producer has to sell their produce the market, they are concerned about price fall, so they will go in for selling in the market in the futures market, taking a position because they are concerned about price fall. So that is where they will hedge in the futures and options. Whereas where a consumer level, if they are concerned about their future requirements, procuring any particular commodity for raw materials perspective or feedstock perspective, they can do the hedging or locking in their uh, prices of commodity. Yeah, Indraksh.
Yeah, sir, your I think video is off, sir. Can I request?
Yes, sir. Okay, please.
Yeah, sure. Sorry. Yeah, Indrakshi.
So the next question is, what is the minimum amount required to commence trading in the commodity exchange?
Okay. Minimum amount to trade in a commodity exchanges will vary from broker to broker, from member to member, because based on the risk profile of the consumer, you can start open an account, but on a very general level, you can deposit a particular amount in terms of 50,000 to 75,000 to start out opening an account and having the base initial margin, as I mentioned about before trading. So this amount which I mentioned is a very general amount. It would again can be discussed on one with your broker, and based on the risk profile and the broker and agreement between broker and client, that would be determined. But yes, somewhere between 50 to 75,000 is on the where a client can get into starting trading, not only covering the initial margin, but also a little bit of the exposure margin. Yes. Yes, Indraksh.
Yes, sir. So we can share your presentation to the participants. We will upload the presentation also in our BFSI portal. Okay, sir. So, so with this, I think the participants, they have many queries. They can mail us for their query resolution also. So, sir, with this, we can come close to this question answer part. So now,
is there
yeah.
any particular query apart from these
Yeah,
three?
one more question, sir. One more question. Presently, what do you think are real challenges for growth of commodity exchanges? Are they due to cash-based transactions and opaque funding structures?
This is a more of a regulatory aspect which is there, and again, will not be able to speak in my capacity. But yes, exchanges have been playing a very important role in the guidelines of regulator to curb any kind of illegal trading, which I mentioned, and to trade on commodity exchanges and avoid any illegal trading and avoiding any trading through any not a registered member of the exchange. So exchange is very stringent on that part, and whatever regulatory guidelines are there, based on that, the exchanges operate. Yes, ma'am. Next question. Any other question? Your voice is on mute.
Oh, sir. No, sir. As of now, we are complete with this question answers. Means they have many questions. Yeah, I'm sure the participants, they have many queries. They can mail us, sir. They can mail at bfsi@icmi.in. They can also contact you. They can also mail you. So now I would request CMA Divyendu Roy, sir. He's the Additional Director and HOD and Secretary of our BFSI board, to give the vote of thanks, please.
Yeah, thank you, Indrakshi. I thank our chief guest and speaker Ashish sir for his nice presentation today. And today, sir, we have in our chat box 2-3 members giving us that we should have another session on technical analysis. I think, sir, since we have given a macro picture today, we should have a technical analysis so that it actually encompasses the entire gamut of this commodity trading. Yeah, and I with this I thank our chairman, the CMA Chittaran Chattopadhyay, for always motivating us to have such sessions. I think online session is the best session where we can connect across the globe. People join us also. Today we also had a sizable number And we also thank our President CMA Vibhuti Bhushan Naik and Vice President CMA TCS Srinivasa Prasad for always motivating us to organize these sort of events for updating and giving awareness to our members and others in this area of capital markets. And we also thank our BFSI board members for always helping us to give such uh, organize such events in this online forum. We also thank our IT team, our CPT team, and also our team members Indrakshi, Shantanu, and other team members, so for always supporting each other to organize this sort of event on this online forum. With this, we close today's session, and I hope the next session after Diwali we will start again with the webinar session. And all the members, we wish happy Diwali and very prosperous new year, upcoming new year. With this, we close today's session. Thank you.
Thank you.
Thank you, sir.